In today's episode, we look at three very interesting stories. In the first story, we'll understand why the RBI kept repo rate unchanged recently despite other important economies across the world reducing it. In the second story, we look at why food delivery giants like Swiggy and Zomato are now betting on 10-minute food delivery. And in the third one, we'll understand what is happening with the Indian bond market and why foreign investors are once again looking towards it as an investment opportunity. Welcome to the Daily Brief Show by Zerodha, where our aim is to simplify the biggest stories in the financial markets and give it to you in a very consumable manner. I'm your host Anurag Bansal, and today is Thursday, the 10th of October. Yesterday, the Reserve Bank of India or the RBI decided to keep the repo rate unchanged at 6.5%. For those of you who are new to this term, repo rate is the interest rate at which the RBI lends money to commercial banks. It is an important tool that they use to control inflation and support economic growth of the country. Now, some people were expecting that the RBI might cut interest rates because lowering it can make borrowing cheaper and therefore encouraging spending and investment in the country. But the RBI actually chose to hold off, and they had very specific reasons. And as investors, it is very important for us to understand why this was the case. So today, let me break down why RBI made this decision and how this ties into what is happening globally. First, let me explain what is happening globally. See, central banks are making different moves regarding interest rates. For instance, the US Federal Reserve or the Fed recently cut its interest rates by 0.5% to stimulate growth by making borrowing more attractive. Now, several central banks in other emerging markets have also started to cut interest rates after tightening them a little earlier. To give you a better sense of the global picture right now, there have been 21 rate hikes and 130 rate cuts globally in 2024. To give you a comparison from 2023, we saw 161 rate hikes and only 84 rate cuts. So globally, the trend seems to be towards lowering rates in order to stimulate economies. But despite this trend playing out, the RBI seems to be choosing a more careful path. So the question here is, why is the RBI deciding to stay put while the Fed and other economies are cutting rates? Look, the RBI Governor Shaktikanta Das and his team have a bit of a delicate balancing act here. While they're focused on controlling inflation on one hand, they also want to keep India's economy growing on the other hand. Now, what is important to know here is that the RBI has recently shifted its policy stance to neutral. And when a central bank adopts a neutral stance, it usually means that they are keeping their options open and ready to respond based on however the economic data evolves. Now, this flexibility for the RBI is very, very crucial because currently inflation could suddenly flare up, especially with global factors like rising commodity prices. At the same time, economic growth in India also needs a lot of nurturing. So the RBI wants to be sure that inflation is under control before they consider doing any rate cuts. In fact, Deputy Governor Dr. M.D. Patra mentioned something very interesting during a recent press conference. He mentioned something called the inflation hump. And what he meant by this is that the RBI expects a short-term rise in inflation and wants to wait for that to pass before making any major changes like cutting interest rates. But despite being neutral on their inflation and rate cut stance, RBI is very, very optimistic when it comes to India's growth. They're projecting that India's economy will grow at 7.2% in FY 24-25, which is a very, very strong number compared to other countries across the world. Now, the question is, why does the RBI believe so? See, they see a few key reasons. First, strong private consumption or the fact that people are spending more. Second, strong government spending. And third is a good agricultural performance thanks to favorable monsoon rains. Now, there are also positive signs on the demand side. Both rural and urban consumption are strong, government investments are picking up, and exports are benefiting from better global trade conditions. But while the growth outlook is strong, inflation is still a bit of a concern for RBI. The RBI expects consumer price index or the CPI inflation to be around 4.5% for the current financial year. Yes, inflation did drop to 3.6% in July and 3.7% in August, but it is expected to rise again in the short term. You might wonder why? There are a few factors again. First, there is an adverse base effect. This means inflation numbers from last year were so low that this year's number might look higher by comparison itself. On top of that, rising food prices, uneven monsoon rains affecting crops, and global commodity prices, especially crude oil, are all putting upward pressure on inflation. Governor Shaktikanta Das also mentioned that data from the Food and Agriculture Organization and the World Bank shows rising food and metal prices globally, which could push inflation higher in India. But that said, the RBI does expect food inflation to ease up by the fourth quarter of this financial year once the Kharif harvest comes in and the outlook for the Rabi season looks favorable. But they're not in a rush at all to cut rates. They want inflation to comfortably come back within the 4% target before they even think about loosening the monetary policy. With that out of the way, let's shift gears a little bit and talk about financial stability, which is where things are a little bit concerning. See, the RBI highlighted some concerns about the health of banks and non-banking financial companies or NBFCs. Now, even though banks are doing fairly well, the RBI is more worried about lending practices in the NBFC sector. There has been an increase in unsecured lending by NBFCs, particularly in high-risk areas like consumer loans, microfinance, and credit card debt. To counter it, the RBI is now urging banks and NBFCs to tighten lending standards and closely monitor loans after they approve it. Governor Shaktikanta Das also pointed out that some NBFCs have been pursuing aggressive growth in these high-risk areas. If this is left unchecked, it could threaten financial stability. Now, the RBI prefers to see these companies self-correct before stepping in with stricter regulations. The RBI governor also made it very clear that while regulatory actions have had a positive impact until now, the RBI is still keeping a very close watch on banks and NBFCs. They want lending practices to remain strong and sustainable, particularly in vulnerable segments of the market. Moving on to the next story, let's talk about how Swiggy and Zomato are now betting big on 10-minute food delivery. See, Swiggy and Zomato are now competing to deliver food faster than they have ever before. Both of these companies are now trying to deliver food in under 10 minutes, which is following a trend that has already started to reshape grocery delivery in India, where speed has become a key selling point. Swiggy recently introduced a product called Bolt, where the promise is food delivery in just 10 to 15 minutes. But interestingly, this is not the first time that Swiggy is trying to deliver food quickly. Back in March 2023, they launched something called the Insta Cafe through their quick commerce arm Instamart, but it didn't quite take off. The reason for this is that food delivery usually has different challenges as compared to groceries. Food preparation takes time and ready-made options are very limited in nature. By the way, Zomato on the other hand is also stepping back in this space after they stopped their Zomato instant service in 2022. Their CEO Dipinder Goyal recently explained that while the initial attempt didn't quite work, he still very strongly believes in the potential of 10-minute food deliveries. He mentioned that if any player can get it right, it could be a game changer for all players. But the main challenge here is finding the right partners who can prepare food fast enough. Now, while this may sound very fun and exciting at first, there are some gray areas with 10-minute food deliveries that are very critical to consider for you and me as investors. First, there are limitations on what can actually be offered. To make food ready in such a short time, the menu has to be very simple. Only items like instant noodles, sandwiches, coffee, reheated frozen materials, etc. can be delivered here. And this very point further leads us to some more important questions. First, will customers be satisfied with the taste and quality of food that is prepared so quickly? Second, with such limited choices, will people very soon get tired of the same options over and over again? And third, how often do people really need food delivered in just 10 minutes? Is it really solving a regular need, or is it more of a once-in-a-while convenience? Also, in fact, given the gray areas, you could also think of Swiggy and Zomato's push for 10-minute food deliveries as a move to defend their positions from a potential future threat rather than anything else. And that is because recently new competitors have sprung up with quick food delivery options like Bangalore-based Swish and Zepto's Zepto Cafe. But as exciting as these new ventures are, the financial picture of 10-minute food delivery is still very unclear. Currently though, the real focus for these companies seems to be customer acquisition. The questions we must ask as investors are: 1. Will people really use this service regularly, and more importantly, stick with it? Second, which company will be able to strike the right balance between speed, food quality, and customer satisfaction? Third, will this 10-minute delivery trend catch on, or will the novelty wear off after the initial excitement? Fourth, and most importantly, could this be the beginning of a bigger change in how food delivery works for us? Now, of course, none of us know the answers to this. It's very early to say, but given the speed at which things are changing today, we definitely must keep a tab on this as investors. With that, let's move on to the third story and discuss a major shift in the Indian bond market that has been attracting the attention of global investors. FTSE Russell, which is a big name in global index tracking, recently announced that from September 2025, Indian sovereign bonds will be included in its Emerging Markets Government Bonds Index, or EMGBI. What does this mean, you might wonder? In plain and simple terms, it is said to bring about 5 billion US dollars in fresh foreign investment into India's bond market. And this is not happening in isolation. It is following similar moves by JP Morgan and the Bloomberg Index Services. To put this into some perspective for you, back in 2021, JP Morgan decided to include Indian government bonds in its own emerging market bond indices. And this was huge because these bonds are worth over 330 billion US dollars, and Indian bonds will have a weightage of 10%. Now, this inclusion process will take place between June 2024 and March 2025, and JP Morgan's move alone is expected to attract over 25 billion US dollars of inflows into India, which is a lot of foreign money pouring into the country. Now, this is particularly interesting because historically speaking, the RBI or the Reserve Bank of India has been very cautious about foreign investments in Indian bonds. They have set very strict rules such as quotas and holding periods, mainly to manage the impact of foreign investment on the rupee and protect it from volatility. But things began to change once the RBI relaxed these rules, which made way for foreign investors. And what happened next? JP Morgan added Indian bonds to its index, and there was a surge in investments. Between October 2023 and September 2024, foreign investors put in a massive 1,80,470 crore rupees into Indian government bonds. And if that was not enough, Bloomberg Index Services joined the party by announcing that it would start including Indian government bonds in emerging market local currency index in January 2025, and there's now the FTSE Russell. So Indian bonds have become very attractive to foreign investors now. The numbers, by the way, are already showing this shift. Foreign ownership of eligible Indian bonds have jumped from 2.7 to over 4.5%. And if you look at the total percentage of foreign-owned Indian government bonds, it has grown from 1.4% before all these announcements to roughly 3% today. But the real question is, how is this affecting the bond market? Look, bond yields are a very good way to understand investor sentiment, and we've seen a noticeable drop here. The yield on India's 10-year bond has come down from 7.15% in September 2023 to around 6.76% in October 2024. Now, this is a very significant shift, and analysts expect yields on 5 to 10-year bonds to stay in the 6.55 to 6.75 range in the near future. Now, something worth noting here is that this drop to 6.7% happened even before the RBI cut interest rates. So we might not see much of a drop in yields through traditional rate cuts. But even at these lower levels, it is still a big win for Indian companies. This is because lower yields mean cheaper borrowing costs, which eventually helps boost overall economic growth. So all in all, in summary, the inclusion of Indian bonds in global indices is making a big impact. It is pulling in foreign investment, bringing down bond yields, and helping India's financial markets connect better with the global system. Now let's move on to the final section of the day, which is the small news pieces or tidbits. First, PepsiCo reported strong double-digit revenue growth in India, Egypt, and Vietnam despite lowering its global sales forecast. Their CEO emphasized Southeast Asia and India as critical growth regions for them. Second, ship leasing in Gift City has doubled between July and August 2024, with 16 lessors now operating. Aircraft leasing also rose, which solidifies Gift City's position as a hub for these activities. Third, Sri Lanka's new government plans to reassess Adani's wind projects over sovereignty concerns, casting uncertainty on the group's regional energy and infrastructure ambitions. Fourth, GIC is considering selling its 50% stake in Greenco Energy Holdings, potentially valuing the renewable energy giant at 10 billion US dollars. This sale could attract new investment into India's renewable sector. That's all the news and stories I have for you today. I hope you found value in today's episode. This is the Daily Brief Show by Zerodha, and I am your host Anurag Bansal signing off. I'll see you tomorrow. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.